calling Bitcoin digital gold. That's lazy thinking. Bitcoin is not digital gold, and I'm tired of people pretending it is. Gold stores value, Bitcoin rewrites value. Here's what I mean. Have a look at this chart. It shows Bitcoin at the top and the gold price at the bottom. There is very little correlation. The two assets do not move in the same direction at the same time. We can also quantify this here at the bottom. That's the correlation coefficient. So that's a mathematical way to measure if two assets move in the same direction at the same time or they move in opposite directions. Now the correlation coefficient is not really close to 1. It's just fluctuating randomly. So really, gold and Bitcoin, they move quite independent from one another. Bitcoin is not gold 2.0. Have a look at this. This is Bitcoin measured in gold. So we divide the Bitcoin price by the gold price to see how much is Bitcoin outperforming or underperforming. And interestingly enough, since 2017, since Bitcoin hit $20,000, it did not outperform gold. We've got much more volatility. We've got our crashes of more than 80%, or over here more than 70%. But all of this additional volatility did not lead to additional return. We've got more risk, but we don't have more return with Bitcoin relative to gold. And so when that's the situation, it becomes more and more important to time the market, right? There is the argument Bitcoin is still a good investment if we simply just pick the bottoms. If we buy over here and then sell over here, it can still be the better investment versus gold. But we have to time the market. Timing the market becomes more and more important. There are still ways to outperform gold by more than 300%. But then we have to buy when Bitcoin is low. Have a look at this here at the bottom. This is the maximum drawdown from the all-time high of the Bitcoin versus gold chart. And it seems like we tend to turn around at either somewhere around 72% below the all-time high, or in the extreme case, 82% below the all-time high. This is where the support tends to be. If we want to be extremely optimistic, we could say that maybe those drawdowns from the top tend to decline over time. So Bitcoin becomes less risky relative to gold with every bear market. And maybe we are already turning around now. Maybe now is the time to buy Bitcoin. But again, this is a line that just has 2 to 3 other data points. It's very hard to say whether or not this bounce will prevail, or we are going down lower again to our 72% or 82% below the all-time high. If we were to fall 82% below the all-time high, then the ratio would end up somewhere around here. So that would mean Bitcoin relative to gold could fall, in the extreme case, by another 48% from here. But again, that's the most bearish scenario. The bullish scenario is that we are going to turn around already at the current level because the bear markets might become less extended with every cycle. Really, Bitcoin tends to trade more like a tech stock. It tends to go up and down with the Nasdaq 100. And so let's compare Bitcoin with the Nasdaq 100 instead of with gold. Then we get this chart here. The result is not that different. Again, we had zero outperformance since Bitcoin hit $20,000 at the end of 2017. We've got more volatility, but we do not have long-term outperformance. Maybe we can make the argument that the tops tend to rise over time slightly, but who knows where we are bottoming out here. Let's have a look at how much this chart tends to fall from the all-time high. Again, the same kind of development. In prior bear markets, we tended to fall 82% or so versus the Nasdaq 100 from all-time high to the bear market bottom. The last bear market was not as severe, and we could make again the argument that maybe the next bear market will be even less severe. But even with that argument, relative to tech stocks, Bitcoin could still fall by another 25%, relatively speaking. So that now means that maybe tech stocks will appreciate while Bitcoin does not, or Bitcoin falls and tech stocks stay stable. This is just relative performance. Relative to gold, we might have already bottomed. Relative to tech stocks, it seems like Bitcoin still has some more room to fall, which then in turn would of course mean that gold might not perform that well in the near term. Here is Bitcoin relative to the US money supply, because Bitcoin got created at the height of the global financial crisis in 2009. So that was as a counter movement to the monetary base dilution that we had when all the banks got bailed out, right? The idea was that Bitcoin is hard money that can't get diluted by the government. The bailout, the bank bailout, was referred to in the very first block of Bitcoin, right? So there was a reference to a New York Times article that discussed the bank bailout. So really, Bitcoin, it was created as a counter movement to monetary debasement. And so Bitcoin still does outperform the US money supply. When we look at this top at the end of 2017 to the current price, we do see how Bitcoin still outperforms monetary debasement, which, by the way, the US money supply grows by roughly 6.8% per annum. Bitcoin is not necessarily outperforming gold anymore, and it also might not outperform tech stocks anymore, but it does outperform monetary debasement. Again, let's have a look at the same analysis. How much does Bitcoin fall from the all-time high, this time in relation to the monetary base? Again, it does not look like we have already bottomed. Only relative to gold we might have bottomed, but relative to tech stocks or relative to the monetary base, there's still potentially more selling pressure. Here is the S&P 500 relative to the monetary base. So buying stocks does help to prevent monetary dilution. All of this inflation, all of the expansion of the monetary base can be fought against by buying stocks. This is a very long-term chart. It starts in 1959. The dotted line, that's the average ratio of the S&P 500 versus the monetary base. So we can see that the vast majority of gains in the stock market is simply just debasement of the US dollar. The vertical line, this is when Bitcoin got created, the beginning of 2009. And so we can see that since Bitcoin's creation, we've never really seen a real crisis. We've never seen a dot-com crash or a global financial crisis or the big depression with the oil crisis. We've never seen anything like that during Bitcoin's lifetime. And so there is a case to be made that the S&P 500 might be somewhat overvalued. It might drop by roughly 50% to reach its long-term equilibrium with the monetary base. The Shiller PE ratio, so the price to earnings ratio of stocks, also supports that thesis. So the idea here is that we buy stocks based on its earnings, right? The reason why we buy stocks is just to participate in the earnings of a company. So when the PE ratio is high historically, it means we now have to pay much more for the future earnings, or the market is just anticipating a lot of growth in the earnings. Now, whether or not this will happen is still up to debate, but we can say that the PE ratio is now at very similar levels to the height of the dot-com bubble, or even above the levels that we saw just before the Great Depression in the 1930s. We might not even want to buy the S&P 500 when investing in stocks. If we just buy the top 3 stocks, we tend to outperform owning the entire index. So right now, that's Nvidia, Apple, and Google. A mix out of those 3 stocks might do better long-term than the S&P 500. The top 3 stocks have, of course, changed over time. At some point, it was General Electric, ExxonMobil, and Pfizer. And of course, over time, this has changed. But just owning the top 3 stocks might be much better than owning the S&P 500. Unfortunately, the situation isn't that clear this time. This here is the technology index, the Nasdaq 100, relative to the S&P 500. And while technology stocks are currently even more expensive than they were at the height of the dot-com bubble, we could make the argument that long-term tech stocks simply outperform regular stocks because they tend to grow faster, because the fundamentals are better. We can scale faster, we can scale with very little marginal costs, etc. It's easy to build and grow a monopoly in the technology sector. .com was simply an accelerated run that then led to a subsequent crash. But the very long-term trend, right, this chart starts in 1985, seems to be relatively steady. And maybe the high valuation is not the problem. Maybe the problem during .com was just too quick of an appreciation. Here's the simplest of the Bitcoin charts, right? Bitcoin in US dollars. This here is a curved line. There's nothing mathematical about it, but it's very interesting how those tops tend to align quite well. When we just take the US dollar chart, again, it seems like there's still more room to fall. Bitcoin has not yet fallen as much as it did during prior bear markets. This is the drop from the all-time high. Even if you expect that the current bear market is not as severe as prior bear markets, we'd still fall roughly 70% from the all-time high. At what kind of price level would that bring us? Let's measure it from the top. 70% means a price of roughly $37,000 per Bitcoin. Usually the trend turns around. The bearish trend tends to turn around when the long-term holders are even in losses. When the market in general is in net unrealized losses, not in profit anymore, that's when the selling pressure tends to ease. It's pretty much with any market like this. Let's say you buy a house. You bought that house for the long term, you bought it for an elevated price, and now house prices come down. What are you doing when the current house price is lower compared to what you bought it for? If you do not have to sell, you're probably not going to sell. You're simply just waiting for the price to recover. And so it's the same for Bitcoin. If you bought Bitcoin and you believe in Bitcoin very long term and currently the price is coming down, you are in net unrealized losses, you might just wait. So the selling pressure tends to ease whenever the market as a whole is in net unrealized losses. But so far, the market is not in the losses. It's still in net unrealized profit. And some people might consider to take that profit. So where's that flip? When is the market net in losses? The answer is at $54,000. So different models lead to different price levels. We can't be certain of anything, but we have to simply work with the data that's available. So we might already start buying at $54,000 and then we can buy more as the price falls further and further and further. And it's very unlikely that we're going much lower than 40K, unless of course the global market in general is in a big crisis. If we see another .com, then due to correlation, Bitcoin might fall much more than it ever has in the past. Again, Bitcoin has lived through this period here. It has never lived through a real crisis. And so short term, I'm simply just following the moving average strategy again. We are still below the 44-day SMA, that's bearish. We are still below the 125-day SMA, that's bearish. And so I continue to bet on falling prices for Bitcoin. I will only bet against those momentum indicators if we are extremely cheap, if we fall below those realized prices. And then those purchases will be for the very long term. They will not just be for short-term trading. Short to medium term, I believe the moving averages work the best. Now, I'm surprised how most people still don't understand how the macro defines everything. When Bitcoin is going down, then all the altcoins go down with it. And while you can try to pick an individual altcoin that might be a winner, that's probably long-term a losing battle. And so really, figuring out where the macro is headed is the most important consideration. It doesn't matter what cryptocurrency it is. When Bitcoin drops by more than 80%, any portfolio gets crushed. And these kind of moves happen regularly. The last time was when Terra Luna and FTX went belly up, a drop of more than 77%. And so it's very clear that crypto moves in those trends. Some people even think that it's 4-year trends, right? 4-year cycles. This might become a self-fulfilling prophecy. I'm not willing to go that far, but there are clearly overarching trends, and I try to time them in a way. The very straightforward way is using moving averages, right? Here, for example, we've got the 200-day simple moving average in Bitcoin. We can bet on rising prices whenever the price is above. We can bet on falling prices whenever the price is below. And so that way, we avoid quite a bit of the bear market. The question then becomes, what is the best moving average duration? Should we take the 200-day moving average, or should we potentially go shorter? Maybe it's the 175-day that's better. Maybe it's the 150-day that's better. What moving average duration historically worked the best? Should we maybe take just the 100-day? We're getting closer and closer to the price as we reduce the moving average duration. And it seems to have its advantages, right? We tend to enter a bit earlier when the moving average is shorter. But then we also get this random noise every now and then where you go above and below and above and below the moving average again. So I made a calculation to find out the best moving average for Bitcoin. There are two data points that are interesting. The one over here, the 44-day simple moving average. So on the x-axis is the moving average duration. On the y-axis is the annualized performance. The black line here is the comparison to just buying and holding Bitcoin. So the 44-day works pretty well. The 125-day also works pretty well. And so this is what happens when we use the 125-day simple moving average to bet on falling and on rising prices. Bitcoin is in white, the backtest is in turquoise. We can even optimize a bit of leverage, so we can go long with some additional risk, but then also additional return. And then this is our long-term outperformance. Every horizontal line here, that's a 10x. So this is a logarithmic chart. We move from this outperformance to this outperformance. So that's for the 125-day simple moving average. The 44-day works slightly better. So there are slight differences. If you don't want to trade too actively, just use the 125. If you want to optimize return, use the 44. Here's the 125-day simple moving average. Here's the 44-day simple moving average. And because trading according to that moving average is quite cumbersome, there's a lot of trading signals, I have created a capital pool to automatically execute those trades. And since we started that capital pool in October of 2025, we are making money, while Bitcoin, of course, went down. So that's the beauty of riding the trends. The outperformance can be massive. The last month's return annualized are 78%. The backtest indicates an outperformance versus Bitcoin of 115% per year. So this is a premium page of this channel of Bitcoin Strategy for automatic copy trading. It's all built on top of a decentralized finance protocol, a protocol that enables efficient trading and leverage and automatic copy trading. Hyperliquid is the largest so-called perpetual futures exchange. And I do think there is some security, at least in numbers. There's already 4.3 billion worth on the platform. And so our 3.5 million are just a drop in the bucket. The capital should be relatively safe. I think it's safer at least than if I was to personally hold the funds, right? All the funds are held by the platform and you can withdraw your capital at any point in time. There is no fixed lockup. And so instead of trying to find the few altcoins that might make money when the overall macro is bad, isn't it better to use approaches that historically worked very well? An approach based on statistics, an approach based on numbers. This is where I put my money and I'm very satisfied with the results. So if you want to co-invest in that strategy, feel free to check out Premium. It's currently $125 per month. You can simply sign up once, deploy your capital and then unsubscribe again. Of course, I hope that you will stay longer because besides copy trading, there's also a lot of tutorial videos that might be helpful for your long-term wealth building. But again, it's not required. If you just want to deploy your capital into the strategy, you can just get in, sign up, deposit your funds and exit again. A link to Premium pops up here on the screen. Looking very much forward to seeing you there. Thanks again for watching. See you next time on YouTube as well. Cheers.